Hello, how are you?
Hello, I am well. How are
Great.
you?
I'm fine, thank you. Very well. And delighted to see you and delighted for everyone to send their questions in for you, Denise, over the next half hour or so. So let's go into that a little bit. It is true that definitions over the years sometimes change. How is the term defensive with regards to the equity markets kind of changing?
Yeah, let's start by looking at history. I mean, I think that most investors know that if you thought that we were going into a recession, or if you thought that contract by about 20% or more, sort of an average basket of what we used to call defensive stocks or sectors like utilities, healthcare, consumer staples, the old telecommunication services had really strong odds of outperforming the market. And in some cases, actually providing absolute returns being positive. It's not 100% odds, but it's pretty close. And we call them historically those defensive sectors because when really there's economic turmoil, you still tend to go to the store and buy toothpaste. You tend to, ex-COVID, go to the doctor and pay your doctor bills. You tend to pay your utility bills and your cable bill. That's why we call them defensive. But when you look back in history, you always have to give an eye towards historical data that is also changing, not just what is the same usually, but the fundamentals of those sectors often change. And that's what you highlighted in healthcare. And that 1999 date is critical. And you see this in both healthcare and consumer staples. That was actually the peak in operating margins. And what was different in the, up until really in the 80s and 90s, 70s, 80s, and 90s, where you highlight that healthcare was both offense and defense, you were in a backdrop where EBITDA was growing about 15% a year and margins were expanding for those sectors. So they provided you some ballast when the market went down, because that is the area of the market that still had pricing power. And yet they were still offensive sectors because growth was still so good. That is very different situationally from where we are right now. Like I said, operating margins peaked in 1999 and have been deteriorating ever since. And for the healthcare sector specifically, the last 18 months have been the worst 18 months that I have in the data set going back to 1962.
So it's fascinating. Does competition explain a lot of operating margins peaking and going down the other side? There's just more competitors. You can buy toothpaste from many other places, for instance.
For consumer staples, it is exactly that. I mean, I think private label and the explosion of SKUs really started the change in trend of the trajectory. And I think that we talked about earlier, I think it was 2001, please don't quote me on the exact date, when Procter & Gamble actually reduced the price of, I think it was Crest, one of the Crest data points because of that. So in consumer staples, that is definitely the case. You went from a situation where this was a staple where I had to buy Crest and everybody bought Crest to a situation where I have to buy toothpaste. Right. So there was, a loss of brand power and there was a loss of profitability associated with that brand power. The story is a little bit different in healthcare for a lot of different reasons. I mean, that's where we saw 1999 was around the time we saw the first batch of patent cliffs. And that was sort of, in some ways, looking back, one of the canary in the coal mine or a bell ringing event for what could be a peak in terms of the ability to price drugs. And I think that the recognition of that changing in terms of not only from an absolute perspective, but, especially relative to areas of the market like technology, that change will influence how defensive these sectors will be over time and what your risk reward is if you get that timing wrong. You might end up in a situation where, despite the fact that they have lost their luster in terms of fundamentals, they still provide ballast to the downside. But to the extent that you're wrong about that economic recession or about that big correction in the market, you get less and less and less alpha out of those sectors because they have less and less operating margin expansion and relative earnings growth. So it really is trouble playing defense the way we classically think of defensive areas.
So does utilities fit that as well?
Utilities does fit that to a lesser extent. And interesting. So I'm not a huge fan of utilities, which we've talked about. And we can talk about why, they've outperformed over the course of the last, I guess it's the last 4 months really, or 4 to 6 months. Utilities have been one of the leadership categories in the overall market, but you do see that deteriorating trend with returns, right? So operating margins don't make a ton of sense to calculate in terms of the utilities model, but you do still see that, especially after deregulation, where returns are nowhere near what they used to be back in the day. So that would again give this, potential consequence that, well, yes, defense is cheap. And many investors might think, well, given the fact that defense is cheap and risks remain, wouldn't that be a nice call option? But I think the deterioration in fundamentals behind the scenes shows you that all defensive sectors might very well be cheap for a reason. I think where utilities looks a little better relative to healthcare and consumer staples, if you think again, like backing up, what does defense really mean quantitatively? Well, it usually means that your earnings growth doesn't vary a lot. Back to that, where you still go and buy toothpaste, you still go to the doctors, where there's areas of the market where it varies a ton, right? Do you buy the new iPhone? Maybe you don't if you're sort of scaling back on equipment, or maybe you do, maybe that's the new staple. But, maybe you don't buy a new lawnmower, or maybe you don't buy some of these capital investment things for the rest of the market. So the rest of the market really varies, but these stable sectors stay pretty steady in terms of earnings growth. You are not seeing that currently in healthcare and consumer staples. There is a ton of earnings volatility where there never has been. And I think that that's a really big red flag in terms of whether or not you can expect these defensive sectors to be truly defensive the way we have thought of them in history.
When you go into sort of the comparables and taking a look at what versus the factors of low vol, what if people are seeking low vol, as you just pointed out, this doesn't fit that factor, it sounds like.
That's exactly right. I mean, I think low vol isn't acting as low vol from an earnings perspective as it has historically. And then you can say, okay, if it is different, right? So in healthcare, you can see it quite clearly. Price volatility on an absolute basis is not relative. Price volatility is still low, but earnings volatility has now changed. So it is much higher. So the fundamental volatility behind the price volatility is now really looking quite different. And the question is, does this have an impact when there are those differences? And my answer is, well, it hasn't really been different historically, but my answer is likely yes, because there is a correlation between relative valuations, how cheap or expensive something is, and the relative volatility of the earnings stream, which makes a ton of sense. If you think of, I want to price up things that are stable because I know they will be there for me when I need them. And if things are volatile, well, I don't want to price them as quite as high because there is that volatility that if I have to sell at the last minute, I don't really know the price that I'm potentially selling at or the earnings that I will be marked out at. So I think that there is a reason why valuation does correlate to that earnings volatility. So the change in earnings volatility that we're seeing in healthcare and consumer staples, I think speaks to the fact that it will likely stay cheap in this market.
So if it stays cheap, are we looking at a value trap?
That is exactly the case, right? So it screens more and more like a value trap to me. So it's not this situation where, hey, defensive stocks are cheap, that provides you a call option of this increased protection. I think that there's something quite nefarious in the data behind the scenes that's saying it's really very, very different fundamentally. I don't think that we can use historical analysis to say it's going to be the exact same every cycle because of these changes.
Right. That's so fascinating. So the margin degradation, just kind of going back to that a little bit, competition, explaining some of it. Where else? I mean, what is the opposite side of that? It sounds like tech is sort of the opposite side of that because they're in literally the opposite situation.
Yeah, is tech the new stable? In some ways, I think that when we talk about, again, conceptually, when we say defense in the, let's call it 70s, 80s, 70s were the Nifty 50 era, and then the 80s where consumer staples was both offense and defense. The interesting part about it was there was pricing power and there was consistent growth. If you say what sector fundamentally does that look like now, it looks a lot like technology. Technology in some ways has become both the growing category and the staple category. You don't really need a new iPhone, except when it falls apart. You need a new iPhone. I need a new iPhone right now. My battery is always running down, right? So do I want to get an iPhone? No, but I'm probably going to have to get an iPhone. And that is both brand loyalty and pricing power and growth. And that's what we think of when we think of staple growth, the Nifty 50 era. And that is why the premium that we're actually not really seeing in technology stocks right now, I think is likely justified, which makes, tech sort of that, what we just talked about, what healthcare and consumer staples used to be. It could be the technology is now both defense and offense.
That's so interesting. So with that, and this has been kind of the question from the beginning of the year, how do you diversify?
Yeah, which is very, very complicated, right? Because
it must be. Yeah.
I mean, in some ways, I think owning technology, there's no guarantees in life, but from the point of view of where we are right now with a 1 to 2 time horizon, when earnings growth is my base case, which is accelerating, I think technology stocks are an outperformer. They may or may not be leadership, but I think it's really hard to make the case to not own them here. I think that is where growth is, and I'm not seeing any valuation disconnects. In fact, in the nascent correction that we just saw in technology stocks that has since been reversed, they actually got into the bottom half of their distribution on price to free cash flow on a relative basis versus the rest of the market. So I'll say, like, at least in some of the areas that I look at, maybe not price to book, not exactly forward PE yet, but when you think about free cash flow, which has been a more efficacious factor through time, what you're looking at is actually pretty compelling valuations for the technology sector that's got a pretty compelling growth trajectory. So to those who say that I think technology is overextended, I think I'd like to diversify not only away, but out of it, I would say that's caution. Have a very long sort of detailed conversation with yourself in terms of risk rewards about that, because all the fundamental and valuation things I see in play for technology stocks, as much as they're 30% of the market, and the market is getting increasingly concentrated, is still a very positive risk reward. And because it's a 30% weight, and if you throw in communications and some of those consumer discretionary names, you start to get upwards of, 35 to 40%. When you look at that, you say, in some ways, I get the fact that people want to have another experience that might, in case this doesn't work out, what could that negative correlation look like? And I think that that's why it's important, at least in the equity market, to talk through the story of defensive options. So if you say, well, I would like to diversify away my portfolio from being so technology dominant, well, defense seems like a good strategy here, right? That's cheap and should work in case we get into a recession. And that's why I want to be very clear on that the odds and fundamentals around defensive sectors have really changed quite a bit. So within the equity market, I still lean more on even interest rate sensitive sectors that obviously hasn't worked out year to date in terms of real estate and financials, and other cyclical sectors like consumer discretionary and industrials, but more specifically on small and mid-cap stocks to diversify away that technology exposure when you think of within the equity framework.
That's fascinating. Okay, so within the equity framework, here's a question. You touched on this earlier, and it goes back to the performance that we've seen from utilities just of recent months. So views on the utility sector, maybe you can just go back to this. Denise, performance is almost matching tech on a year-to-date basis. So yeah, maybe just your thoughts.
Yeah, great quote. I'm glad somebody brought it up. And I think it might be in my charts on LinkedIn. I think we'll flip it to that because I did an internal note about utilities and what it means, because I got a lot of questions from the diversified portfolio managers too. Like, hey, it's tech and utilities. Is this weird? Does it, if it's not weird, does it signal anything? And, people are calling for the fact that, hey, this is defensive and not really a good situation that utilities have outperformed. And I actually said this to Pamela before we even talked about it. Whenever people ask me about utilities, I almost know by definition they've had a top quartile performance, because nobody talks about utilities until they absolutely have. right? So, and when I went back and I looked at the data over the last 6 months, you've hit in those top quartile levels. The interesting part about utilities is usually, and by usually, I mean like 75% of the time, when people ask me and it's top quartile, that means over the next 12 months, you only have 15% odds of utilities outperforming. So by the time you ask me about them is usually one of the best sell signals that I have to monitor. And what's even more interesting, and this doesn't matter if it's cheap, because utilities are cheap in the sense that they are in the bottom quartile of their range on relative forward PE, not trailing, but relative forward PE. So they're cheap, and you think that that would improve the odds. It does not, in fact, improve the odds. Actually, it takes that 15 to, just around 10, which, look, 10% is not zero. So Denise does not know what will happen to utilities. But I would say that the risk reward is negative. And what's interesting is that when you look at the forward 12 months odds for the market, it's monotonically related to how much utilities have already outperformed, meaning the more utilities have outperformed, the more likely the market is to advance over the next 12 months, and the more likely utilities is to underperform. So it almost looks like a negative sentiment signal that you want to buy. Like if people are owning utilities, even if the market is rising, it means, or it could mean, that people are afraid, that sentiment is much more negative than you think. And then the market has the ability to climb that wall of worry. So if you were asking me to just look at all the data and say, Denise, what does it mean? I would say, oh, it's actually a bullish signal for equities. And it's actually also a bullish signal for bonds, meaning yields usually fall over the next 12 months. So I
right now,
a strange situation, right?
So but that's awesome that the question itself can be actually a signal to you. I love that. That's kind of fascinating. I love that. It's quite meta. Okay. What is the longest delay historically between an inverted, so we're going to the yield curve here, to an inverted yield curve and recession that followed? We're 20 plus months since the inverted yield curve of 2022. So yeah, what are your thoughts?
Listener knows more about those number of months than I do. And I will tell you why, because I actually don't think that the yield curve is a very good signal. For one, I think we're on the cusp. From the notes that I read from other strategists, it's like, well, I think that the yield curve might be getting to the point at which maybe the yield curve is wrong. The problem with the yield curve is like yield curve is not just one thing. I think when you talk about the yield curve, you're probably talking about 2s, 10s, right? So you have to pick points on the yield curve, but that answer is going to be different if you pick 3 months to 10 years. It's going to be different if you pick 1 year to 10 years. And it's going to be different if you look back to 1960 versus if you start, because the 2 years got issued in 1976. Right, so that time frame is very variable. But to your point, I think we are on the cusp of, oh boy, it should have happened by now. I don't view that as, it used to be a great indicator that is now defunct. I don't think that the yield curve was ever a great indicator. So if you look at it from my perspective, if I look at all the data going back to 1962 and I use the 1 year, not the 2 year, that's the way you do that. When you look at the range of outcomes from the point at which the yield curve inverted to the time the recession hit, it was 6 months to 4 years. Right now, to your point, the yield curve then uninverted, and we have not uninverted yet, but that's actually, the signal itself, when you really measure it, doesn't have a whole lot of validity. So that 4 years gives me very big pause to make any prediction about the equity markets based on this one indicator, especially when you backtest it and you say, okay, if I bought the equity market every time the yield curve inverted, what are my average returns over the next year? They're 10%. So what it tells you is that at some point after the yield curve inverts, you will have a recession. The problem is it doesn't tell you what that point is. So that point could be this year, it could be next year, or it could be in 3 years. And that matters a lot to your equity market returns. If you don't have the ability to time, which this indicator doesn't give you any ability to time, then you don't really have a very certain signal of what equity returns will be anyway.
It's fascinating. It's an indicator. And as you say, you particularly have so many indicators. So there's a lot of richness in looking at other things as well. Can I pick up on something you mentioned earlier, the market concentration story, which sort of brings you back to what is and isn't defensive? How do you diversify away from tech? Just tell us a bit more about the market concentration. I think a lot of people have been thinking about this for, at least since the beginning of the year, end of last year.
Yes, I know a lot of people have been thinking about it because the thought leadership team came to me and said, can we write a white paper together on market concentration?
Another indicator. Yes.
Yes. So, and it is, we actually, so be on the lookout for that white paper. So I will be co-authored with PM to be named, and actually Roy Justice, who is in our technical group, who they have all the data going back to 1920, I think, on market concentration. So it is true when you define market concentration as the top 1, 5, or 10 stocks as a percentage of the overall market cap, we are now more concentrated than we ever have been at any time during the last 20 or 25 years. That's how long I've been working on it, right? If you open up the sort of lens and look further, we have been much more concentrated, even in the 1, 5, or 10, than we have now. And we have stayed at that concentration level for decades through bull markets and bear markets. So back to, it's kind of like the yield curve, like it tells you something. And generally speaking, you go, oh, it sounds like it should be a concern. But mathematically, when you look at it, you go, well, I don't know how, like, unless I can time this, it doesn't give me enough of a concern that I would say sell equities or that I would say buy equities. It's sort of no signal. Market concentration looks the exact same way to me. You told me something, right? The market is very concentrated. It's driven by a handful of stocks. And I think what that means maybe is that it's a very risky situation for the market. But when I look at the historical data, it doesn't really tell me that that's true. It doesn't mean that it can't be true, but it certainly doesn't give me enough information when I look at all the historic data that that would be something I want to bet on. It kind of goes back to the, what do you think about technology here? It looks like table stakes to me.
Table stakes. What's table stakes?
Stakes.
Oh, table stakes.
Or tables. Let's coin a new phrase, table stakes.
Sounds like a cottage, like a rainy day game. Yeah. With this, we also hear a lot about private markets, companies going private, which does sort of take, the concentration to new levels as well. Some companies being bought up by either private equity or whatever it is, but they will come back. I mean, the exit strategy is often an IPO, not always. There are other ways, but you have to think there'll be a cycle in there somewhere.
You do think, I mean, and we haven't seen that to date. And there definitely is a secular trend of, I mean, I think, what is it? The Russell 3000 is under 3,000. And if you chart it, it's sort of like a secular downtrend of the number of stocks in the stock market, which is sort of interesting in and of itself. I mean, I think that could almost be its own white paper in terms of, look, if there is really less public equity, and that's the most liquid option, should you pay a premium for those less stocks and the fact that they are liquid versus private equity? So I think you're right. There will likely come a time where we see another IPO round where we re-equitize the equity market. But so far we have seen that, lesser and lesser, many companies going private.
For sure. And it's interesting. I mean, is that in the white paper? That's part of the concentration story, I guess, or it must be one element.
It's not. It can be, right? Because we haven't written it yet, but that's a good idea. That should be in the white paper.
Do part of that, how all of that works. So let's go back to just sort of some of the beginnings. Just again, the idea, the concept, the perhaps reimagination of what defensive means right now as you're looking at your equity portfolio.
Yes. So if you define defensive, like in terms of characteristics, so let's think of it from a quant factor perspective. What am I looking for? I'm looking for low price volatility. I'm looking for low earnings volatility. And I'm looking for growth in both bull and bear markets, or you can define it as in recessionary economic conditions or growing economic conditions. And if you run that screen and do that basket, right now, that's not what is in the low vol basket. And it's also not what's in the consumer staples, healthcare, and utility sectors. That screen would give you a lot of stocks that are in the technology sector. And this is sort of a long-winded way of thinking about, how to reimagine sectors and factors into, in some ways, potentially thematic trends. That is, what is the next sector or what is the next theme? And it may very well be, it looks a whole lot like what we called the Nifty 50 area, which was an amalgamation of things that looked like consumer staples, where this time it's going to look like technology stocks.
Okay. So the exact sort of top three, bottom three, I think you've told us in the past, but tech is obviously up there at the top. And then
Yes.
what interest rate sensitive areas?
So I would put financials right below tech, which obviously hasn't really worked out year to date. I still see them as a coiled spring. And probably the catalyst is a rate cut, which is still my base case over the course of the next year, given where I see inflation being currently and where the level is of the Federal Reserve. So I think technology, financials, I think industrials have an attractive risk reward, and I think real estate has an attractive risk reward. And then on the bottom three, I would say, let's pick on consumer staples, let's pick on healthcare, and then also still energy. I think energy was one of the best sectors year to date, and I think has kind of come off a little. I think that the risk reward is still deeply negative because we are at peak fundamentals and valuation is usually no tailwind in that situation.
Really, really interesting. It's because energy has been such a fascinating with so many new components to it in the last couple of years, as we know from sort of the geopolitical side of things. But it's done relatively well on worry, essentially.
Yes.
Yeah. Okay. So maybe that's it. If you've got it in the bottom for now. Denise Chisholm, thank you so much for joining us on Fidelity Connects, and very grateful for your thoughts and helping us to redefine certain terms that we invest with.
Yes, absolutely. Always great to be here, Pam.